So, you've got a universal life insurance policy, and you're probably asking yourself a really important question. Should I keep it, or is it time to look for something else? That's exactly what we're going to figure out today.
Does this sound familiar? You open your policy statement, you look at the numbers, and you realize, wow, the costs are going up. Maybe you've even gotten a letter from the insurance company asking for more money just to keep your coverage. If you're not in your head right now, stick around, because this is a really common problem.
Okay, so what's really going on here? It all comes down to something called the internal cost of insurance. You can think of this as the true price tag for your death benefit. And here's the catch. That price tag is designed to get higher every single year as you get older. Back when you first got the policy, it wasn't a big deal. But as time goes on, well, those rising costs can start to cause some serious issues.
So, how do you know if your policy is starting to buckle under that pressure? Well, thankfully, there are a few key warning signs you can look out for.
The very first red flag is when you see your cash value start to drop. If your premium payments aren't enough to cover those climbing internal costs, the policy has to get the money from somewhere. And that somewhere is your cash value. It's like the policy is literally eating its own savings just to stay alive. Now, this next sign is a lot more direct. This is when you get that official notice in the mail. Your insurer is telling you straight up that you need to pay more money, maybe a lot more, if you want to stop the policy from collapsing. This is a huge signal that things are not going according to plan. And this is the most critical warning sign of all. Every year you get a projection, it's called an illustration. If that piece of paper shows your policy is set to run out of money and lapse at, say, age 85, but you expect to live to 90 or beyond, you've got a massive problem. You could end up paying for decades only to have no coverage when you need it most. So all of this brings us right back to that big question. How do you decide? Let's look at the key things to consider when you're weighing whether to keep your policy or find a new one. All right, let's break this down, because it really depends on your situation. You probably want to keep your policy if you absolutely need that coverage for your entire life, maybe for estate planning or, and this is a big one, if your health has gotten worse, because getting a new policy might be tough. On the flip side, if you just need coverage for a set amount of time, like until the mortgage is paid off, and you're still in good health, replacing it with a term policy could save you a fortune, especially if those premiums are getting out of control. It's all about matching the tool to the job. Now, if you are leaning towards replacing your policy, there's a really smart way to do it. For most people, the safest and most flexible option out there is something called convertible term insurance. Here's why this is such a great strategy. First, you get really affordable coverage right now for what you need today. But, and this is the best part, it comes with a built-in guarantee. You have the right to convert it to a permanent policy later on, no matter what happens to your health. And you get to do it without having to go through another medical exam. It's all about giving you control and keeping your options open for the future. Of course, it's not always a simple keep or replace decision. Sometimes the best answer is somewhere in the middle, so let's check out a few of those clever middle ground options. You've got some real flexibility here. You could, for instance, reduce your current policy and then buy a cheaper term policy to fill the gap. Another fantastic option is converting to what's called a Guaranteed Universal Life, or GUL policy. These have fixed premiums that never go up, and if you have cash value built up, you can almost always move it to a new policy without paying any taxes. I just mentioned a 1035 exchange. I know, it sounds super technical, right? But it's actually pretty simple. It's just a rule in the tax code that lets you move money from one life insurance policy directly into another one completely tax-free. It's an absolutely crucial tool for making a change without losing the cash value you've already saved up. Okay, we've covered a lot. You get the problem, you see the options. Now let's put it all together into a safe, step-by-step action plan to make sure you do this the right way. The order you do these things in is absolutely critical. First, you need that up-to-date illustration from your current company. But here's the most important rule of all. You need to apply for and get your new policy approved and active first. Have that new coverage 100% in your hands before you even think about canceling or changing your old policy. That way there is zero risk of you being left uninsured. After all this, you might be thinking, wow, that's a lot to juggle. And you're right, it is. Which leads to one last really important question. How can you be sure you're looking at all the angles and really making the best possible choice for you and your family? Well, that's where having some expert guidance can make a world of difference. We specialize in this.
We can help you compare your current policies side by side with all the other options. Convertible term, GULs, you name it. We'll help you find the absolute best value for your specific needs.
And the best part is, our services are completely free. So if you're ready to get some real clarity on your policy and figure out the best path forward, just reach out. Give us a call at 770-755-1565, or you can find us online at annuityexpertadvice.com. We're here to help.